Hello, everyone. Welcome back to Tech Tune Up. It's May 21, 2024. A lot of good stuff to talk about today. Don't go anywhere because in a few minutes, yes, we will be talking about Nvidia, which reports its quarterly results tomorrow after the close. But let's go through my lineup. Remember, I'm always looking not just at what specific stocks are telling us about themselves, but what are the broader reads in the technology sector, and sometimes even more broadly, the entire US market, and even some foreign markets from time to time. So the first on our list this week is Microsoft. Microsoft has made some news this week. They've announced their Copilot Plus Surface PCs. And what is unique about these is that they are going to feature AI capability. And it looks to me like they're making a push, and other vendors will follow, for what we call AI on the edge. Currently, any AI products and services and other products and services are hosted in the cloud. Now we will have at least some AI capabilities, some processing on board on the PCs. Now, it sounds exciting. And if Microsoft can't make it work, nobody can, because they dominate the PC operating system software space. They have a 49% ownership in OpenAI, which got the whole AI thing going in November of 2022. But I will tell you this. So far, their Copilot add-on for their operating system, where if you want the functionality, up to this point, you pay $30 extra per month. It doesn't look like it has been selling very well. And we're about a year after that initial product release. So we'll see what happens. Michael Dell, I admire him very much. He did concur yesterday that he says that all the PCs that you will be buying beginning in 2025 will have AI on board. My takeaway is, if AI is ubiquitous on your PC, if it's ubiquitous on your smartphone, which it will be, does it become a needle mover financially for any company? Or does it become a utility service? Like today, broadband internet connection and a lot of products related to that are seen as kind of utilities. At the beginning of the internet bubble in the late 90s, that was special. Now, just utility. Oh, you have that? So does everybody else. I just don't know if it's going to be a differentiator, but we'll see. I think this is interesting. The next bit on JP Morgan. Why is a tech analyst talking about America's biggest bank? Well, its CEO, Jamie Dimon, might be the most respected person in finance. Regardless of who was elected president November 5, you might see him as the next U.S. Treasury Secretary. In a year or so, maybe he takes over for Jay Powell as the chairman of our central bank, the Federal Reserve Board. But he made an announcement, which I think is very interesting. Every employee, going down to the guy that pushes the broom in the office at night, are going to be trained on AI. And so if the standard bearer in financial services goes that direction, it probably boosts our thesis, doesn't it? Next, Apple. I've been troubled by Apple. It's never been, at least since we have started this program, on the Meeks buy list. But I will tell you, I think it gets even scarier from here, because there are reports out of China that the online retailers there are offering discounts on iPhones as much as 20%. And remember, Apple has positioned itself with an elite product. And you do not discount elite products, top of the line products, at 20%. And it shows you that the iPhones have really slowed down in that really important geography for Apple. Last quarter, they announced that their iPhone sales were down 9%. And the problem for Apple is that's about 60% of their overall sales. So stay tuned, but that's definitely a negative input. Next, not only will Nvidia be giving us the score on AI today, actually tomorrow, but there's other companies in the AI ecosystem that I'm following this week. Supermicro and Micron, which have been on the Meeks buy list. Actually, you may recall, Micron is my best tech stock pick. It's been for a while. It's been great, and it still is. But both of these companies, SMCI and Micron, are reporting at sell-side conferences. That means they're brought by investment banks to some hotel ballroom, and they give an update on their business. Now, of course, these updates have to be a live webcast. So not only are we going to check in tomorrow night with Nvidia, but some key companies in the AI infrastructure build, Supermicro and Micron, also not reporting quarterly earnings, but sharing an update with us this week at these conferences. It looks like the meme trade that I had warned about on last week's program has fizzled. Like, for example, GameStop is down 24% since we last spoke. I told you it was BS. And here is another tell. Both of the beneficiaries of the meme stock bounce from a couple weeks ago, the big beneficiaries, AMC, the theater chain, and GameStop, both took the opportunity when their stocks soared on no new news to sell more equity to investors. And this is interesting. They were happy to sell shares, not even at the market price, but at a discount to the market price. They were desperate. They knew that their stocks were going to go down as fast as they went up. So be wary. Now, Trump Media, ticker symbol DJT. I think it's the meme stock of this year. Of course, Trump Media was not around when we had the meme stock bubble back in 21, 22. But this company announced their quarterly results yesterday. They did not even have $1 million in revenue. They had $700,000 plus in revenue. That is not even a small company. It cannot be a publicly traded company. So they have essentially no revenue. And because they have no revenue and they have all these egregious expenses, they lost last quarter $328 million. One of their original founders is going to the big house. They also had to fire their auditor because the auditor had committed accounting fraud. Anyway, bad, bad, bad. Next, SpaceX, which in the Elon Musk empire is the only company I like. I think Tesla is a terminal short, but I do like SpaceX. Now, SpaceX is a private company. It'll go public at some point. But even as a private company, it does funding rounds. And in the last funding round, that company was valued at $180 billion. Next, Tesla. I think it only gets worse for Tesla. You know, they probably will have a little lift around their August 8th robo-taxi announcement. Of course, I think it's all going to be marketing spin. But in the meantime, not Musk, but other senior execs at the company have been selling their shares. If you are on the board of directors, why would you sell your shares with the stock already down 50% from its high? Yet they're doing it. So that's a real negative tell. A Workday, ticker symbol WDAY, is a enterprise resource planning software company. Think of software that your company would use to track inventory, accounts receivable, even work with human resources. They're going to report this week. And even though they're not in the upper echelon of that group, I'm going to be watching because that's an important tell. Next, Oracle. Oracle announced that it is bleeding badly from its really boneheaded, in my view, $28 billion acquisition of the healthcare company Cerner a while back. Now, they have moved their headquarters from Silicon Valley to Nashville, Tennessee, which is a big healthcare hub, to try to fix it. But man, everybody talks about this wonderful integration of the tech sector and healthcare, right? Two huge portions of the U.S. economy. Very few people have any success with it. And Oracle's much lauded at one time acquisition of Cerner has been an out and out bust. Next, there's a smaller cap. You probably haven't even heard of it. Semiconductor capital equipment company that I've been following for many, many years. It's called Teradyne, and they do semiconductor test equipment. I'm always looking for tells. And this one had a really good quarter, and this is a positive tell for the others in its peer group. Next, Netflix. Remember, I've told you, whenever you're tempted to invest in media stocks, ignore Warner Brother Discovery, ignore Paramount Plus, ignore Disney, and just buy more Netflix. Those companies are trying to recover from declining legacy businesses based on people cutting the cord, whereas Netflix is a greenfield video streaming company. So Netflix, to boost its own growth, a year or two ago, had two initiatives. One was to make sure that all the people among your family and friends were paying for their subscriptions. And so forcing people to pay for family share has boosted their revenues a little bit, right? Because people were just stealing the stuff. But more importantly, I think this is really interesting. They announced the other day that their ad-supported tier, right? Netflix originally came to the dance with the claim, we're never going to show you ads. Well, they decided that they're going to lower the monthly fee to people that are willing to watch ads. And so they did that. A lot of people thought, oh my God, this is going to disrupt their business. This could be trouble. But here we are. We had 23 million of this paid ad tier subscribers on January 1 of this year. And now it's over 40. So it's been a grand slam home run. Next, Cisco. Cisco has announced earnings recently. This is a 1990s yesteryear stock. It was the data networking company or the plumber that supplied all the equipment in the late 90s to connect the internet. So, of course, it had a run. But now things are going quite badly, and be wary of what I call value traps. The stock had a little bit of bounce when they reported their earnings because they were better than very low expectations, but revenues are collapsing. Stay away from this value trap. Do not get intrigued. Next, I'm a fan of Uber, even though Uber took a little bit of dive based on failing to meet expectations last quarter. That usually has me sell a stock ASAP. But there were some things, for example, some non-operating losses potentially in their venture capital portfolio. But Uber, which does rideshare and also Uber Eats food delivery, has actually made some pretty interesting follow-on product announcements. So I continue in that space to like Uber long-term, and I do not like Lyft. Next, Reddit has reported. I've been poo-pooing this IPO from a couple months back, and you remember my thesis here is they will never be able to compete with the two monsters, Meta and Alphabet, in digital ads. However, they're kind of distracting folks with a shiny object over here, and that is selling their data to folks that are going to use that data to build their large language models. And they have announced a deal with OpenAI. They haven't announced another deal with Alphabet. But I think at the end of the day, all these potential deals that they could do for data licensing, it's going to be 10 to 15% of their sales is good, and the rest of it's crap. So please, don't buy Reddit, particularly after it's moved up here. Next, we have Amazon. And I will tell you, I think this is pretty interesting. Last week, I went to a book signing of a book. If you are a Amazon bull or bear, you got to read. It is written by Dana Mattioli, who is a Wall Street Journal reporter. And the only thing she does over at the paper, and of course I call the Wall Street Journal the Meeks Bible, is she writes about Amazon. And she just published a book. I went to the book signing and spoke to her last week. It's called The Everything War. I tell you, if you like Amazon, excuse me, I got a cold, but the show must go on. You should read that book because unfortunately it's a really negative tale. But in investing, we got to listen to the bulls, we got to listen to the bears, and we got to make our own decision. So next, here is the conclusion. Here is what you've been waiting for. Let's talk about Nvidia. So first of all, it's still on the Meeks buy list. So that tells you what I think about Nvidia, even though the stock tripled last year and is up 90% year to date in 2024. So they report their numbers after the close. Now, this is a company that has a January fiscal. So its quarters are slightly off companies that have the typical December fiscal year. So the typical company's quarter will end December 31. Whereas Nvidia's quarter will end January 31. So just know that when it comes to reporting quarterly results, there's going to be a little bit of a skew. But Wall Street is expecting $5.59 earnings per share and $24.65 billion in revenue. I tell you this, if they report that, the stock will go down a lot because the whisper number, what Wall Street really is looking for, that may not be shown in these databases online, I don't think that the company can get away without getting hammered on their stock if their revenues are any less than 26 billion. So again, 24.5 billion is the marker officially. I think the whisper number is 26 to 27 billion. So I'll be looking at that very, very carefully because everybody knows this company's doing great. No surprise. But the worry is, when do they hit the revenue wall? Because next fiscal year, they're supposed to earn over $30 a share. 2 fiscal years ago, they earned $3. So they've got an earnings per share increase tenfold. So the stock's rise is completely legit. Stock's not even really expensive here, if you believe that the growth keeps going. For this year, analysts expect the company to double its EPS. In the out year, we'll have EPS growth of another 30%. Right now, the stock's trading about 30 times next year's earnings, perfectly in line with its growth rate. We call that a very fair, maybe even cheap, 1 PEG ratio, PE to growth. The price earnings ratio equals the earnings growth in that year. So I have some anxiety about this, right? Because it's on Wall Street. It's not what you do. It's what you do versus expectations. And it's not what you do versus printed expectations. It's the whisper number on the street. And that whisper number for revenues is over 26 bill. So not only delivering that, the company is going to have to show us that they have a long runway in their benefit from building out the AI infrastructure. They're also going to have to tell us that their technology is so superior that they're going to be able to fend off a bunch of competitors that are coming. There's been a lot of competitive announcements from the like of Intel and Advanced Micro Devices. Now, they don't ship product yet, but we'll see. And so the other thing that's important for NVIDIA to share, for us to be bullish, is that at some point, we are going to have built all these large language models. The next stage of the internet, of the AI infrastructure build out is inferencing. And so NVIDIA, game over. They had all the market share in stage 1. They're going to have to tell us that they expect to have as much market share in stage 2 or not lose so much. So those are the puts and takes on NVIDIA. What does that mean for you today as a trader? If you own NVIDIA before the conference call tomorrow, just hold it. I am too anxious to encourage you to buy it ahead of the call. But almost regardless of what they say, I think the runway is long for NVIDIA. And so if you have for one reason or another, I mean, this is going to be an investor relations event, not necessarily a fundamental financial event. If the stock gets whacked, I'm so easily found. Reach back out to me. I'll let you know what I think, but I may want to buy it on a dip because over the next several years, even though the stock went up threefold last year, 90% year to date. In the next 3, 4, 5 years, I think this stock could go up another 3, 4, 5-fold. So just worried a little bit about the potential short-term investor relations or public relations miscue. But we'll see it, because as of now, the stock is not necessarily that expensive. Again, trading at a 1 PEG ratio, 30 times PE for next year, and 30% EPS growth. That's actually pretty attractive. All right, let's get on to my, as always, buy list. As you know, green are fresh money buys. Yellows are, they're good enough to be on the list. Hold them if you own them, but don't buy them fresh. So let's just go through the ones that I continue to like. Remember, Micron is my favorite idea. It's already done great for us here on Benzinga. But they do announce not their results, but they will give an update to Wall Street analysts at this sell-side event this week. Microsoft, Meta, Amazon, Synopsys, all AI beneficiaries. And I think Microsoft with an added kicker based on this announcement yesterday of the AI-focused Copilot Plus PCs. Nvidia, I'm still buying it long-term, but yeah, I'm a little cautious before I can delve into all the details tomorrow night. Dell, Taiwan Semi, Alphabet, Booking.com continue to be great performers. I continue to like them here at Benzinga. I also like 2 other stocks in the AI infrastructure periphery. That is Arista Networks and SMCI. And as I said at the beginning of the broadcast, SMCI, another one of those stocks that's going to be giving us an update when their CFO speaks at a sell-side conference this very week. All right, let's get into some tech trends. We always have to have that weekly interest rate check, because I've told you before, when it comes to tech and aggressive growth stocks, it's 20% fundamentals. And we go through all those details here, but it's 80% rates. And tech companies and other aggressive growth stocks need to have rates go down to support their future valuations, just based on the math that we academics call the discounted cash flow model. So right now, the risk-free rate, which is the yield on the U.S. Treasury, is 4.41%. It's actually come down recently, which is a good sign. But I will tell you this, based on all the tea leaves that I've been reading, and I continue to read every week, I don't think the Fed is going to lower rates by more than 1 or 2 ratchets downward in 24. I actually think they don't even consider it until we get to September, even though the central bank meets a couple times between now and then. And I will tell you this, which would not surprise me at all, is actually if they don't lower rates at all this year and they get after it beginning in 2025. And when that is announced, if that becomes the consensus view, unfortunately, we're going to have a correction in these tech and aggressive growth stocks. So that's why I talk about this so much. The next thing that is really kind of stuck in my craw, and I think it's a good opportunity to talk about this. This is a tech investing tip. I will tell you this, in my experience, I always value companies on the lesser of 2 growth rates, the revenue growth rate and the earnings per share growth rate. I'll give you a good example. I've been off the case on Apple for a long time because Apple's revenue growth, particularly with the 60% of their total revenues with iPhones cascading downward, down 9% last quarter alone, the revenue growth has been a very paltry 2 or 3%. Actually, that's even the forecast going forward. They've had 4 or 5 quarters where the revenue actually declines year to year. But they have a much higher earnings per share growth rate because they're buying back their stock. Earnings per share is earnings, which is right off the income statement. Sales minus expenses equal earnings. That's the earnings, and that's the numerator in the earnings per share. The denominator is the number of shares outstanding. If you buy back your stock, you take some shares off the table, you lower your total shares outstanding, and same numerator, smaller denominator, bigger result. So you guys, when it comes to, people talk about PE ratios and such, excuse me, value the company on the lower of two growth rates, revenue or earnings per share. Whichever one is lower is probably the true sustainable figure. It'll keep you away from a bunch of what I call value traps in tech. Anyway, I did not know this at the beginning of my career. Now I do. It's made me a much, much better tech investor. Biden's tariffs. We had a lean into this last week. Now they've been announced, including a fourfold tariff from 25% to 100% on Chinese electric vehicles. This obviously is posturing before the November 5th election. So at the end of the day, it's more PR because it doesn't really move the needle. The Biden administration has slapped tariffs on about $18 billion of Chinese goods. During the Trump administration, they slapped tariffs on $300 billion of goods. But you guys know where I come across on this. Doesn't matter if you're a Democrat or Republican, I believe in fair trade. And even though it might hurt your feelings, I think we may need the Chinese more than they need us. And so I hope in my sphere of influence, the tech sector, that we finally get back to some kind of combination of competition and cooperation. Two other things before we sign off. This cracks me up. One of the hottest sectors, and there's 11 sectors that make up the economy in recent months, have been the utility sector. Utility stocks are usually where my 95-year-old dad goes because they're safe and they pay high dividend yields. But some of these utility stocks have been rocketing because they're believed to be beneficiaries of the insatiable demand for power from these AI-driven data centers. Now, that is true to a certain extent, but the problem is the tide is lifting all boats. And yes, there are some stocks that deserve to be more expensive because they are beneficiaries. But then there's other utilities that have gone up that are BS, old school, permanently slow growth companies, and now they're trading at an outrageous multiple. I'm going to circle them up because I think we need to come back next week and give you some short ideas of some of those imposters. And the last thing I want to share today is this is a kind of bearish call on the market, or tell, I should say. Remember our friends at Robinhood? I've been poo-pooing that stock for years. It's been good to avoid it. But they just announced yesterday that they are lowering the interest rates that they're going to charge investors for margin trading. So if you are trying to boost margin trading and you get all of these knuckleheads buying aggressive stocks, particularly some of these meme stocks based on borrowed money, that's going to end bad. But when you see a big uptick, not just with this announcement, but overall with margin trading, that's probably saying the market's at a top. So I'm going to keep watching this, but wow, you're actually going to encourage margin trading? What are you, nuts? Anyway, I can't believe some of this stuff goes on, but these guys are knuckleheads over at Robinhood. So we have it. I'm going to be watching very carefully the NVIDIA news. If you want a snapback comment, come back to me. I'll give it to you. If not, I'll be detailing it next week. But I'm Paul Meeks. Our host is Benzinga. I work with these dudes over my shoulder, Harvest Portfolio Management. If you're more of a institutional investor, check me out on my other program called Wall Street Beats, where I'm the tech voice. But anyway, thank you very much, and we will see you next week.